Welcome to the second topic of SIE. Today we're gonna go over common stock. So let's just jump into it quickly as possible. What is a common stock? A common stock is an equity ownership of a company. Now what happens when company wants to raise money? They go into the market through an initial public offering to raise the money. I know there's a process behind it which I covered in the first video. It's called private placement, but so in this topic we're gonna go like they do the IPO, they get into the public market, they get listed on an exchange. Now when the customers or the investors are able to invest into these companies, they get equity ownership. They get the stock out of it, they buy the stock, and that is called equity ownership. With that said, the equity ownership gives voting rights to this investor. Now those voting rights are used to elect board of directors of a company. Now the board of directors are the ones who take all the important decisions about the company, like dividend declaration and record date, how much like dividend declaration date, how much dividends needs to be paid, all that like major event stuff and all those things, the important decisions about the company. Those are the board of directors. Now we're gonna further jump into the classes of common stock. Common stock is divided into 4 classes. First is authorized stock. Now authorized stock is like a checkbook. In a checkbook, what happens? There are so many checks, right? And whenever you fill one out with your signature, that check is the only one you can use. Other ones are just like piece of paper. So those are authorized stock. So what company does? A company says, okay, I want to raise this much amount of money, and they go to SEC and they get, okay, we need to authorize this amount of shares. Now they don't have to use all the amount of authorized stock and sell all, like they don't have to sell all the authorized stock. Like I said, checkbook, you don't have to use all the checks at one time. You just want to use whatever amount. If you want to go give 1 check, 2 check, 3 check, that's what the company does. If they only wanted to raise certain amount of money, they're only gonna sell those certain amount of shares or certain amount of stock. So out of those authorized stock, the amount of stock they sell to the investors is called issued stock. Now issued stock is referred from the company's perspective. That means the stock that is sold from the authorized stock to the investor is called issued stock. Now there's another term called outstanding stock or outstanding shares. Now what is outstanding share? That is referred to as from the customer's perspective, which means outstanding shares or outstanding stock is the stock that is held by the customer. Now at times what happen? The outstanding stock is reacquired by the company. They can buy it back. We always hear like, oh, company bought back their shares. At times the investors donate it back to the company. Now whatever it is, whether they're reacquiring it or whether the customer donating it, that stock that is being reacquired or bought back is called treasury stock. Now these are the classes of the common stock. There's a third topic I want to go is categories. Now common stock is divided into 4 categories. At times you can divide in 5. I think it's 4 categories, which are large cap stocks, mid cap stocks, small cap stocks, and then comes the lowest one, penny stocks, or you can also say micro cap stocks. Now I'm gonna differentiate. Large cap stocks are the companies that everybody hears about, everybody knows about. Those are the largest companies in the world. They pay the most dividend, and they are also called the blue chip stocks. Everybody knows about Google, Amazon, Netflix. These are all large cap stocks. Now mid cap stocks. Wait a second. Large cap stocks are somewhere between US dollars 10 billion to 200 billion US dollars according to FINRA. FINRA is the one that monitors everything and does the exams, as I mentioned earlier. And then comes the mid-cap stocks. Now mid-cap stocks are somewhere between 2 billion to 10 billion US dollars, and they're still in their growing phase. They are still growing to become a large cap stock. They have dividend somewhere in the middle, and these are the technology companies. You can see they are still growing, and sometimes they bring new products and stuff. Then comes the small cap stocks. Small cap stocks are somewhere between 250 million US dollars to 2 billion US dollars. It could be new IPOs at times. It could be majority of the growth stocks bringing some new technology, new products in the, like for example, I can give you in 2020 when COVID was here, Moderna. Moderna was not like the price it was at. It was somewhere in $15, $18 range. It went from small to like above $100, like during that COVID time. During those phase, like these companies just went up like crazy amount of market cap. Now, when we talk about large caps, small cap, mid cap, what is cap? Cap means capitalization, market capitalization. Now, how do you calculate market capitalization? As I told you earlier, outstanding stock. What is outstanding stock? The stock that is held by the customers, right? Or the investors. Now, in order for you to calculate market capitalization, you need to multiply outstanding stock, which is the stock that is held by the customers, multiplied by the current price, current market value of one share. So let's say a company has 100,000 shares outstanding, and currently they are trading at price $5 a share. So now in order for you to calculate market capitalization, you're gonna multiply that $5 into 100,000 shares, which will be, their market cap will be $500,000. So that's how you calculate market capitalization. Now the last one is penny stocks. I'm sure everybody heard about penny stocks. They are the highly speculative. They have huge volatility in it, and that's why the Security Exchange Commission requires any broker dealer to present a disclosure document before any customer wanna purchase a penny stock, because there's the highest amount of risk involved with them. They can go, like those companies can go bankrupt anytime. They can dilute their shares. You can have massive losses on them. They have huge price volatility. Now, there's another thing which people don't know about. If a broker dealer calls you to solicit a trade on penny stock, he needs to ask you about your suitability and your objectives regarding investments. If you don't want to take a huge amount of risk, he shouldn't be presenting you penny stocks. There have been a lot of scams where broker dealers gets away with it, but that's the rules. I'm just telling you. They have to ask you first how much risk you want to take. If you say I don't want that much risk, they shouldn't be telling you any kind of penny stock or recommending any penny stock. If they do, it's kind of against the rules. And they also have to present you the disclosure document for sure. And now it's only if it's during a cold call and they're soliciting you. If those are unsolicited trades, they are exempt from these rules. And other people who are exempt from these rules are customers who have been with a broker dealer for more than 1 year, who have been their customer for more than 1 year. They don't have to have that disclosure document again. In the beginning they probably did, but not again. They don't have to do it again. And they have made at least 3 penny stock trades in past 1 year. So these are some exemptions that they have. If they trade consistently in penny stock, they don't have to go through that disclosure document again and suitability. So yeah guys, these were the things I wanted to go over today, and that was our second topic, and it was about common stock. We got a little bit brief about common stock. and I'll catch up with you in the next one. So take care and have a good one.